I've been a trader for 8 years, and the system that I'm going to be showing you guys in this video is probably the greatest trading system out there as far as entering on a lower time frame. And once I explain how this works and why it works, you guys will probably never look for another trading strategy ever again. This is the same system that I used to catch this long on Bitcoin this morning on the 5-minute, just for some more proof that I actually got in this trade and called it in advance. This is also the same system that allowed some of our users to catch this move on the 1-minute time frame on NASDAQ this morning. What I'm showing you guys not only works, but it's something that I use myself. I wouldn't come on here and show you guys something that I don't use personally. This video might be the video that you have been searching for. Without further ado, let's jump into it. So in short, the system I'm going to be showing you guys is called a V-shape reversal, okay? A V-shape reversal. Now you're like, what the hell does that mean? Well, a V-shape reversal is as it sounds. You're either looking for a V-shape move at your key level, which I'll get into, to take a long position, or you're looking for the opposite, right? A V-shape move going the other way, straight up and straight down. This is the kind of formation that we are looking to trade. Now, why does this work so well? Well, when you're following the rules that I'm going to explain to you in the next few minutes here, you'll realize that this move actually shows you in real time the order flow shifting. This is through something called inverse fair value gaps, meaning on this move down here, you will see a bearish fair value gap or a bearish imbalance. Now, how most people trade bullish and bearish fair value gaps is they'll try to take a short position, for example, off of this bearish fair value gap. What we do is the exact opposite. We wait for price to close back above that bearish fair value gap, creating an inverse fair value gap, and that is actually our entry trigger to go long. This is what it will look like on a lower time frame, like a 1 to 3 minute, which is a time frame we'll be using for entry. But on a higher time frame, on a 5 to 15 minute time frame, it will look like you have literally caught the bottom of the wick before the explosive move in the opposite direction. So yes, you're trading a V-shape reversal, but the reason this is so powerful is not because it looks like a V-shape, it's because the order flow is literally shifting on a lower time frame from bearish to bullish or bullish to bearish. Again, for a short position, it will look the exact opposite. So you have a sharp move to the upside, creating a bullish fair value gap, and you're going to wait for price to close below that bullish fair value gap, creating an inverse fair value gap, and that is going to be your short entry. That is the whole system in simple, okay? Now, we need to add some more confluences because just trading inverse fair value gaps is not good enough. That's why we need to include two other pieces of confluence. The first one is going to be momentum, and the second is going to be a liquidity sweep. Let's start with a liquidity sweep, okay? Because this system only works if you have a liquidity sweep before the inverse fair value gap. So a liquidity sweep is this line that you see here on my chart. There are lots of terms for a liquidity sweep. You can call this a fake out move. You could call this a swing failure pattern. That's the terminology that I've been using for many years. But all you're looking for is a fake out in one direction, waiting for that inverse fair value gap, and then taking that trade in the opposite direction. Again, this is something that just makes sense, right? You are only entering the trade after retail gets stopped out. Because put yourself in the mind of a retail trader, okay? Let's say retail is short from somewhere around here. Where are they going to put their stop loss? Well, they're most likely going to put their stop loss above that previous high, meaning there is a ton of liquidity here that needs to get taken out. Because price seeks liquidity, price will come up to take out all of the retail traders who had their stop losses here and reverse the move back to the downside, meaning this entire move right here above this previous high is what we call manipulation. Okay, this is a manipulation move, and to confirm that this move actually is manipulation, we need to see a candle close back below this high that it failed, creating an inverse fair value gap, which we got on this candle. You can see here we had a bullish fair value gap getting inversed on this candle. That is going to be your short entry. Again, this is a move that we caught in real time inside of the Discord. I'll show you guys another example of an inverse fair value gap if you're still kind of confused as to what that is. So step number one is you need to identify a fair value gap, which is a 3-candle pattern. As you can see here, we have 1 candle, 2 candle, and 3 candle, and we can see we have this gap in between the first and third candle. That is referred to as a fair value gap. Now again, what we want to wait for is a liquidity sweep, which we get right here, and price to close above that bearish fair value gap on this candle, creating an inverse fair value gap. Now for the final piece of confluence, we want to use momentum, so either bullish or bearish divergences. That is shown with this little dotted gray line here. All you want to see on your oscillator is either overbought or oversold, or bullish or bearish divergences. Think about it as you're holding a volleyball underwater. The longer and further down you hold that volleyball underwater, as soon as you let it go, it's going to pop up out of the water. So that's a really good analogy that I like to use for this. Now, when you combine all three of these together, where you have a liquidity sweep, momentum, and inverse fair value gap, you get what I call the manipulation model. Now, to make this easier for you guys, I have actually coded all of this into one really nice and sleek trading indicator. This has built-in liquidity sweeps, built-in momentum filter, as well as the signals for when an inverse fair value gap is confirmed. So as you can see here in real time, it will show you guys the liquidity sweeps followed by that bearish fair value gap or that inverse fair value gap with these really sleek green and purple signals when our trade is confirmed. So you can set an alert for this, or if you're new to this trading strategy, you can simply just follow these signals to start. So if you want this indicator, I'll link it down in the first link in the description below. You do not need to get this indicator, okay? You can backtest this strategy and trade this without any indicators at all, okay? This is a price action strategy. Some people just prefer to have a better visual. For people that are still learning the strategy, maybe they just want a little bit more of a hands-off approach. That's why I've developed this strategy into its own indicator. But again, you don't need that, so I'll turn that off for the rest of this video. So now that you understand exactly what to do and what to look for, how do you mitigate false signals? Because like any trading strategy, it does not have a 100% win rate. So how do we mitigate the false signals from the winning signals? And this is actually a lot easier than you guys think. So to mitigate some of the false signals, the first thing you want to look for is a sweep of external liquidity. This is probably the biggest reason why this trade system will fail, if it ever does, is you guys are taking the wrong sweeps. So for example, this morning on NASDAQ, this was a very obvious sweep of liquidity, okay? If we go to a higher time frame, right, this is a higher time frame pivot point. This isn't just any weak high or low. For example, this would not be a valid sweep. This, however, is a valid sweep. These are just the very obvious highs and lows that you see in the market. This was also the pre-market high as well. I would trade just the New York session and look for sweeps of key levels. So a previous day high or low, a pre-market high or low, a previous session high or low. That is going to be what these levels are right here. For example, this sweep of liquidity right here is not a very obvious sweep of liquidity, okay? However, this low right here is, right? A very obvious low that price is most likely going to take out. You know, for example, we're not going to look for short positions on a sweep of this liquidity. You know, this is not a very obvious key level. We only want to take these liquidity sweeps at key levels. The second way you want to use this trading system is to look for those V-shaped reversals. Even with our indicator, you will still need to look for these very obvious V-shaped reversals. You're not taking any inverse fair value gap. So what I mean by V-shaped reversal is a very fast inverse of that, in this case, bullish fair value gap. You can see that after we swept that high, we had an instant rejection, and within one or two candles, we closed below this bullish fair value gap, creating an inverse fair value gap. That is where the signal flashed, and that was our entry trigger. This was only valid because we had that very fast move up and that very fast move down. If you ever see a move like this is actually a really good example here in real time, where you have this bearish fair value gap right here, where you come below this level, and then you kind of chop around for like 20 or 30 candles, right? Just chopping around, and then you inverse. This is not a V-shaped reversal. This is not a high probability reversal. Price came way below this bearish fair value gap. Ideally, you want to see a quick move below that fair value gap and then an instant reclaim. So this move, for example, would not be a valid entry, meaning if you're entering here on the 3-minute, even though this trade may work out, you know, this is not a high probability trade. We did not see that V-shaped reversal down and then back to the upside. I hope that makes sense as, you know, to what is a V-shaped reversal and what's not. And the third way to mitigate false signals is to trade sessions with volume, right? Trade sessions with volume. So if you live in the United States, right, trade New York session, trade from 9:30 to 11 a.m. Eastern. Don't trade Asian or London session where volume is lower. That's why a lot of the times when you see these A+ setups, it occurs during New York Open, right? Right when the market opens. That is the time to catch these moves, right? You're not just trading randomly at any certain time. You want to be trading sessions that have volume. Again, I'll show you another example in real time on NQ on the 2-minute. So again, we saw that sweep of external liquidity. We actually did have an inverse fair value gap here on the 2-minute time frame. So this would have been a valid signal here on the 2-minute time frame. This was literally just a few hours ago. And again, you want to be targeting some external liquidity levels, right? So probably this high right here as your full take profit. Now, the reason the strategy works so well on top of everything I've mentioned is because the risk to reward is often very big. The way I manage my risk is I move my stop loss to break even at the most recent pivot high. So for example, I have the structure high here. Let's say I enter this long position. I didn't enter this long in this case on NASDAQ, but let's say I did enter this trade. I would move my stop loss to break even after this high and hold it for that big risk to reward, right? Hold it for that external liquidity, or in this case, this candle high right here, here, which is a 1 to 4 risk to reward ratio. Again, this trade earlier this morning, you're moving your stop loss to break even at the most recent structure low. And now you're targeting some external liquidity levels, but targeting these lows all the way down here as your full take profit for around a 1 to 3 risk to reward ratio. I could have gone a lot more in depth, but honestly, this is enough for you guys to start back testing the strategy on your own. Make sure to follow the rules. Make sure to only take A+ setups. A lot of you guys are over trading. You're forcing setups that aren't there. You need to wait for those A+ trade setups, even if it means not trading every single day. You might only get 3 high probability setups per week, but that could be anywhere from 5 to 7 R on average per week, meaning at the end of the month, you are going to be very, very profitable using the strategy. I think that's going to wrap up this video. If you guys want access, once again, to my pro Discord, to where you can follow my own daily setups, as well as get access to this indicator for yourself, make sure to click the first link in the description below. Leave a like on this video if you have enjoyed, subscribe to the channel for more trading content, and I'll see you guys next video.